The cryptocurrency market is a realm of immense opportunity. Fortunes have been made and lost in the blink of an eye. This volatility, while daunting for some, is the lifeblood of the trader, is the engine that drives the potential for extraordinary returns. But with this volatility comes the critical question of timing. When is the best time to buy? When is it time to sell? The allure of timing, the market is undeniable. Imagine buying Bitcoin at its lowest point and selling at its peak. Such a feat would yield incredible profits. However, the reality is far more complex. The crypto market is a whirlwind of information, speculation, and emotion. Navigating this landscape successfully requires a deep understanding of its rhythms and cycles. This essay will serve as your guide to understanding the intricacies of timing in the cryptocurrency market. We will delve into the factors that influence price movements, explore the tools and techniques used by seasoned traders, and emphasize the importance of risk management and emotional control. Remember, while the potential rewards are significant, so are the risks. Let's begin our journey into the exciting and sometimes perplexing world of cryptocurrency trading. Unlike traditional financial markets, the cryptocurrency market never sleeps. It's a 24/7 digital bazaar where transactions occur around the clock. This continuous trading activity contributes to the market's inherent volatility. Prices can swing dramatically in a matter of hours, driven by a constant influx of news, speculation, and trading activity from all corners of the globe. This 24/7 nature presents both challenges and opportunities for traders. The lack of a centralized exchange or closing bell means that prices can move significantly even when you're asleep. This can lead to overnight gains or losses that catch even experienced traders off guard. However, this constant volatility also creates opportunities for agile traders to capitalize on short-term price fluctuations. Day traders, for example, thrive on this volatility, executing multiple trades throughout the day to profit from small price movements. Understanding the implications of the 24/7 nature of the crypto market is crucial for any trader. It requires adaptability, constant monitoring, and a disciplined approach to risk management. The cryptocurrency market, like all financial markets, moves in cycles. These cycles are often characterized as bull markets and bear markets. A bull market is a period of generally rising prices. It's a time of optimism and confidence where investors are eager to buy, pushing prices higher. Bull markets are characterized by strong upward trends and sustained price increases. Conversely, a bear market is a period of declining prices. It's a time of fear and uncertainty where investors are more likely to sell, putting downward pressure on prices. Bear markets are characterized by downtrends and sustained price decreases. Identifying and understanding these market cycles is essential for developing a successful trading strategy. During a bull market, the focus is on identifying promising assets and riding the wave of upward momentum. In contrast, bear markets require a more cautious approach, focusing on preserving capital and potentially profiting from short-selling opportunities. Recognizing the current market cycle can help you make more informed trading decisions. However, predicting the exact start and end of these cycles is notoriously difficult. The 24/7 nature of the cryptocurrency market might suggest that any time is a good time to trade. However, certain days of the week and hours of the day tend to exhibit higher trading volume and volatility. Weekdays, particularly Tuesdays and Wednesdays, often see increased trading activity. This is likely due to the resumption of trading after the weekend and the release of economic data and news events during the week. In terms of hours, periods of overlap between major trading sessions, such as the London and New York sessions, tend to be the most active. These overlaps often coincide with increased news flow and market-moving events. However, it's important to note that these are general observations and there are always exceptions. The cryptocurrency market is influenced by a myriad of factors, and relying solely on day of the week or time of day analysis can be misleading. Instead of focusing on finding the best time to trade, it's more beneficial to develop a trading strategy that aligns with your risk tolerance, time commitment, and market analysis. Technical analysis is a method of evaluating investments by analyzing statistical trends gathered from trading activity, such as price movement and volume. Technical analysts believe that past trading activity and price changes can be valuable indicators of future price movements. Technical indicators are mathematical calculations based on historical price, volume, or open interest information that aim to forecast future price trends. They are essential tools for traders looking to identify potential buying and selling opportunities. Some commonly used technical indicators include moving averages, which are used to smooth out price data and identify trends. The Relative Strength Index, or RSI, measures the magnitude of recent price changes to evaluate overbought or oversold conditions. And the Moving Average Convergence Divergence, or MACD, is a trend-following momentum indicator that shows the relationship between two moving averages of prices. By understanding and interpreting these technical indicators, traders can gain insights into market sentiment, identify potential trend reversals, and make more informed trading decisions. However, it's important to remember that technical indicators are not foolproof and should be used in conjunction with other forms of analysis. The cryptocurrency market is highly sensitive to news events and market sentiment. Positive news such as regulatory clarity or institutional adoption can drive prices higher, while negative news such as security breaches or government crackdowns can trigger sell-offs. Market sentiment, which refers to the overall attitude of investors towards a particular asset or market, also plays a crucial role in price movements. Fear, uncertainty, and doubt, often abbreviated as FUD, can lead to panic selling, while greed and hype can fuel speculative bubbles. Staying informed about industry developments, regulatory changes, and macroeconomic trends is essential for navigating the crypto market. Traders often use social media, news aggregators, and specialized crypto news websites to stay abreast of the latest developments. Understanding how news and sentiment impact the market can help you anticipate potential price movements and adjust your trading strategy accordingly. However, it's important to be wary of misinformation and emotional reactions, which can lead to poor trading decisions. The volatile nature of the cryptocurrency market can be emotionally charged. Fear and greed are powerful emotions that can cloud judgment and lead to impulsive trading decisions. One of the most important skills for any trader to develop is patience. This means waiting for the right opportunities to present themselves, sticking to your trading plan, and avoiding emotional reactions to market fluctuations. FOMO, or the fear of missing out, is a common emotional trap that can lead to impulsive buying decisions. When prices are rising rapidly, it's easy to get caught up in the hype and buy an asset without proper due diligence. Similarly, panic selling during market downturns can lead to significant losses. When prices are falling, it's natural to want to sell and cut your losses. However, this can often be the worst time to sell, as you'll be selling your assets at a low point. Mastering your emotions and developing patience is crucial for making rational trading decisions and avoiding costly mistakes. Remember, successful trading is a marathon, not a sprint. Risk management is paramount in the volatile world of cryptocurrency trading. It involves understanding, analyzing, and mitigating the uncertainty involved in any trading decision. The goal is not to eliminate risk entirely, but to manage it effectively so potential losses are limited while maximizing potential gains. One fundamental principle of risk management is to never invest more than you can afford to lose. Cryptocurrencies are highly volatile and prices can fluctuate dramatically. Therefore, it's essential only to invest capital you are willing to lose without significantly impacting your financial well-being. Diversification is another key aspect of risk management. Instead of putting all your eggs in one basket, spread your investments across multiple cryptocurrencies. This diversification can help mitigate losses if one of your investments performs poorly. Setting stop-loss orders is another crucial risk management tool. A stop-loss order is an instruction to automatically sell an asset when it reaches a certain price. This can help limit your losses if the market moves against you. Remember, effective risk management is not about avoiding losses altogether, but about minimizing potential downsides while maximizing potential gains. It requires discipline, a well-defined trading plan, and the ability to control emotions